Next 20 or 30 minutes, I'm going to go through a monthly market update for October 2019. Probably got about 25 or so news articles that I picked through and I wanted to share with everybody. If you haven't met me before, I run the Simple Passive Cashflow podcast, found on iTunes, Google Play, YouTube, and also have a bunch of meetups and run RA Aloha in Hawaii. And if you guys want to text that number and you get the free version of my ebook. But yeah, let's get right into it. And if you guys have any questions, feel free to type it into the group chat or come off mute and feel free to ask any questions you guys want. And first one here, the Big Short's Michael Burry. So this is the guy that was played by the guy who used to play Batman in The Big Short. He was kind of the eccentric genius character. So he had an article in Bloomberg where he was saying that the central banks, with all this passive investing, which they call is the ETFs and mutual funds, they don't have this price discovery happening. So he's kind of warning that correction is going to be happening, and I do agree that there's going to be a equities correction coming in the future. But if you remember, this Michael Burry character was a little crazy, and the same guy investing in water stocks or water operations. Other news, Fannie Mae eases credit to aid mortgage lending. Now, this is back in 2000 or 1999 that I just dug up. It's kind of funny. The New York Times says that to extend home mortgages to individuals whose credit is not good, basically. And we're starting to see some of this more subprime lending. And for those of you guys don't know, subprime is generally considered lending to people who have lower credit scores. I think still today, it is pretty hard for people with good jobs, good credit to get qualified for a loan on the primary residence, which is a good thing. We're nowhere near where we used to be, but I've seen slowly and slowly the lending loosening up. I believe like 4 or 5 years ago, they moved it from you needed cash reserves for a lot of these properties, so they loosened it up where you could take half of your 401k amount, then 80%, and then now you can take 100% of your 401k into account as liquidity. So that's just one example of Fannie Mae, Freddie Mac loosening up their lending standards. But so far, the credit score has remained pretty high. I think you need to have like at least 620 to 650 to get those type of loans. So here's an article where they're saying Trump is signing an executive order to tackle the lack of affordable housing. Uh, but yeah, I pulled from here, only seven homes were built for every 10 household formed between 2010 to 2016. And we are still at an undersupply from a national level, from a housing standpoint. A couple other comments there from other comments surrounding the need for more housing. So basically what Trump or the government's trying to do is to create more with these programs. I don't know how it's going to come out. Maybe there's some Section 8 or better loans for apartments or better loans for individual property owners. I don't know how that's going to happen, but it's going to happen somehow. But it's not going to be overnight. I mean, it's the government. I've got another article here talking about what the government's doing. So if you've been following the markets the last month, stocks and mortgages rate rise temporarily. People are thinking, well, have the rates bottomed out? And just a reminder, the three things that sort of affect home loan rates are the U.S. trade wars that's happening right now. The latest on that is, there's tariff wars going back and forth. And if you go back through the old green sheets from the past months, kind of talk about a lot about this China trade war a lot. But This past month, things have been pretty quiet. Both sides have kind of put their tariffs on delay, and this kind of come off the forefront for now. Number two, economies are starting to slow, and the central banks are cutting rates. And this is more on the global standpoint. August 5th, mortgage bonds hit a 2019 price high, and it was unable to break above that point. So some of you guys who are ex-stock market technical trader types, you know this is called a ceiling resistance. So a price tries to hit that a couple times, and some people call it a triple peak or double peak, but it'll try and hit that resistance, and that's supposedly a price point where that price probably won't be able to overcome, and will likely retract. But who knows, right? That's why I don't like stocks or technical analysis. It's all a bunch of graphs. All in hindsight, we don't know. We don't have a crystal ball. And the Fed cuts interest rates for the second time in 7 weeks. And this is pretty late news. So the Fed is concerned that the economy is more fragile than previously thought. So you cut the rates as a means to stimulate the economy temporarily, and but a lot of people, it was very controversial because a lot of people thought they didn't need to cut rates in the first place. My commentary here is there politics at play here? And I don't know. One conspiracy theorist could say that, well, maybe Trump wants to get reelected, so he's pressuring people to artificially increase or decrease the rates so that the equity markets go up, because there's a lot of reasons why somebody would vote for somebody, but a big one in this day and age is economy. If their stocks are up, they're happy and they're going to vote the incumbent. So an article from Commercial Property Executive talking about some construction slowed down lately, dropped 1.8%. Kind of minute things here. I subscribe to this newsletter called ITR. I would suggest everybody check it out. It's definitely for pay, but all these articles that we're going through right now, they're all sort of mainstream media. They're made to sell articles and day trade attention. I think ITR is a pretty good one that not a lot of people know about, and you got to pay to play. It's not a free newsletter, so I really like to read it. But anyway, they're calling a 2019 slowdown for the end of this year, beginning of next year. In 2020, we're going to get back and going again. I think some of the other articles later on today in this presentation will kind of show this. We're perhaps already in a recession right now, a very small recession. You got to remember, like the Great Recession, that was only one instance, and that was pretty unprecedented. You guys have any questions or any things you guys want to talk about? Feel free to put it into the chat. We'll keep moving on here. PricewaterhouseCoopers, they're a big accounting firm, and they put together this pretty in-depth trend report every year. It's a pretty big PDF. I got it on the website for you guys to download, but here are the 6 predictions for 2020 and beyond. I've been following this thing for the past 4 or 5 years. Some of it's useful, some of it's just kind of, like number 6 there, it's kind of useless. But they have some pretty neat graphics and some things I don't think about. So it's more economic data if you guys are interested in this. Couple images that I stole from it was, at the end of the day, the population is getting a lot larger. You see 1950s, 2000s, what's projected for 2050. I mean, population is going up, and you can see on the right side, that's sort of how they're making the article was like, hey, people are moving more towards the urban areas, and you can see how that diversion in diversion in how from the rural areas going up to the urban areas there in each of like Africa, North America, Europe, etc. For those of you with teenage daughters, Forever 21 files for Chapter 11 bankruptcy. This actually happened last couple of days. They're going to be closing up a lot of international stores and closing up 350 stores worldwide, including 178 in the US. And I think there were a bunch of articles that came up. They're again these headliners, right? This is the thing that you'll see on the local news, saying, "Oh, Amazon is coming to kill everybody," right? But I found this one article kind of talking about, it's not that e-commerce is coming to destroy all these retailers, like how we've seen all these other companies kind of Photoshop these last 6 months, but it's more that these retailers are doing it to themselves with too much debt. If you read the article, it kind of talks about, despite e-commerce and everybody getting everything delivered via Amazon these days, it's really not that big of a pie of sales. And I think that's a good example of, your amateur investor that kind of reads stuff in mainstream media. That's what they think. But the astute investor, they may be going into shopping mall investments because they know that the dumb money is afraid of that kind of stuff because they get their Amazon groceries and everything delivered by Amazon e-commerce. So this kind of goes back to the other article we had with the Trump trying to kind of incentivize more home ownership. So he's talking about taking down Fannie Mae and Freddie Mac. They originally Fannie Mae and Freddie Mac were private companies, and then they became pseudo government companies. Um, this is an example of, I just see unsophisticated investors getting too excited about when they see these type of headlines. And those brokers, they love to use these headlines to scare investors to keep buying because they think, oh, like, yeah, you're not going to be able to qualify for any loans, or there won't be any lending. But number one, there will always be lending. There'll always be a way for that investors will be able to make a spread on the interest rate and the cap rates. And don't hold your breath on anything the government does. I mean, this is not going to take that long. I mean, this is going to take forever for this to happen. So there's an article about self-storage. This is the exact reason why I don't really like self-storage. A lot of the rates have dropped in self-storage. I think the metric that it's rent per square foot here, can't read it, but basically saying that self-storage is kind of getting a little overheated at this point. I don't like it because self-storage is one of the things that you can build so quickly. And a lot of these deals, it's so much predicated on the rent per square foot that's out there and what's impacted in the 1 to 5 mile square radius. And, like apartment building, those can get built up fairly easily, but everything that's new is an A class. So that's why I like, those B and C class, because even if something is, built up nearby, it doesn't really compete directly. And even more so, like mobile home parks, they don't build those things because the there's no revenue for the city, and not only do normally people, they don't want to permit those things because they've kind of got a bad stigma that go along with them. So self-storage is sort of on the opposite end of that spectrum where they can pop up like that and construction is so quick. So here are 5 things you need to know about California's new rent control law. If you guys still have California rentals, what are you guys doing? You guys need to unload those things. Why would you want to have rentals in a blue state? So we'll skip over this and you guys can read this later if you're so interested in that. Here's a little bit less known publication, Wolf Street. They're kind of a conspiracy theorist website, but they put together this article on Miami real estate sort of tumbling at the moment, and this is a little bit more extreme than what's happening in San Francisco. San Francisco, the last 6 months to a year, definitely a lot of softness in the higher end markets, $1 million and above. And this is why I think we are in some sort of recession right now. Things are cooling off, but I do think we're going to, get back going in the middle of 2020. Read this article. I guess they're working on the Jobs Act 3.0. Somebody came on the Facebook page and said that they kiboshed this Jobs Act 3.0, but they'll always be talking. I mean, there'll always be, keep trying to change things. But this latest thing is what they're saying is, they're trying to change the definition of accredited investor. And what they're proposing here is, well, let's let people certify if they have a certain education or job experience. For example, if you have an MBA, now you can be broke and be an accredited investor. I don't really know what a college education has to do with anything being an accredited investor, but that's the government for you. But I also see it going both ways. I also hear stories of like the accredited investor definition going all the way up to 5 million. So, it's either way. Again, it's our government. It's going to take a while to change anything, but that's Jobs Act 3.0 coming out. Some negative articles about house flipping here. I don't know why you would want to house flip. It's a bad risk-adjusted return. Well, let's get one thing straight. Like if you're the operator and you're the person flipping, very risky, and maybe you're good at it, good for you, but it's very non-passive. I don't do it, and I think a lot of us we get tricked into being a private money lender. Usually the rates will range from anywhere from 8 to 12% on a good house flipper. Some of these more sketchier ones, these desperate guys will give you 12 to 15% or more. But that's definitely not worth it for sure. But the reason why I don't like private money lending is because you got this huge chunk of cash out. You're investing with somebody who is usually living paycheck to paycheck, and it's all active income. And you got to pay the tax rate at the highest rate. Here is my just tax return. I got this done last week. I file in October, but there it is. I mean, that's why you do passive investing. I made 136,000, or me and my wife did. He's a teacher, and we paid 5,700 bucks in taxes. And do the math, that's like 4%. Yeah, take that, government. And line 13 there, I made almost $200,000 in capital gains. I sold a bunch of properties that I originally 1031, so that's why I had a big capital gain. But line 17, that's when I brought over my passive losses that just cancel that out. So that's the power of passive real estate investing with bonus depreciation, cost segregation. If you guys want to learn more about that, go to simplepassivecashflow.com/tax or simplepassivecashflow.com/costseg, COSTSEG, to learn more about what I've been up to there. So that's the end of all like the news articles I found. Here are some of the content I personally created this last month. The number one there, I had a buddy in the Hui group that is also in our passive investor accelerator and mastermind. He wrote this cool story for me that I read on the podcast. It's out right now. Pretty touching story. Kind of reminded of when I was an engineer. But yeah, if you're a lawyer, if you got any lawyer friends that are kind of in the grind, I would share that article and that podcast with them. SimplePassiveCashflow.com/lawyer. Number two there, within the mastermind, we did this little quick survey. 24 people responded. And I personally went and got some umbrella insurance for myself because I didn't have that. And I just kind of wanted to know how much people had. So the takeaway there was most people had about $1 to $2 million at least. Some even had, well, I mean, some people didn't have any, so that was an alarming thing. So hopefully people, it kind of sent the message to some people that they need to get that. And usually a $1 to $2 million of umbrella insurance that goes on top of your auto and your other renter's insurance, that'll cost like 500 or $1,000.
So Lane, in your mastermind group, has anyone ever admitted that they used it?
No, no, I don't think I asked the question either, but I'm sure somebody has. Number three, fitness tips and virtual training for the busy. I kind of went off, took a break from the normal investing stuff. I think we can all agree that your health is the true wealth. If you're not healthy to enjoy all the money that you're investing and saving, then what good is there? For a lot of people investing in syndications and apartment buildings, I had James Eng from Old Capital on to discuss the different lending options, and I thought it was a pretty good high level, enough for the average passive investor to know, what to look out for and what kind of lending terms are out there and what kind of other things like prepayment penalties to look out for. I just sold my 8th out of 11 rental and my 9th one last week. I'm very happy of that. I only have 2 more rentals left to go. And that was the one with that disaster video walkthrough. The total on that was $37,000 of repairs. And you guys can check out the full write-up on that one there. Had another engineer, Jacob, on the podcast. And a lot of people have been really liking these live coaching calls where I recorded. I can make it anonymous, but if you guys are interested in doing that, we can get one of those scheduled. And the only catch is we've got to put it on the podcast for everybody to pull advice from too. And number 8, an SEC advisory sent from my syndication attorney talking about all these rampant capital raisers out there, possibly not following SEC protocols on and taking sponsor-based compensation. So in this world of private placements, you're not allowed to take a commission type of fee. Like if I bring in $500,000, you can't just get like, $5,000 as a finder's fee. That just doesn't fly in securities law. And if you guys aren't part of the investor club, please go to simplepassivecashflow.com/club. And I'm going to kind of go into a little bit of what I've been doing personally. I break it down into Tony Robbins' 6 personal needs. So one of the biggest things of growth I did was I joined Collective Genius, which is a $25,000 mastermind. I think it's kind of cheap for some of the big heavy hitters. I mean, Eddie Speed's in it. That's him talking. We get in like a small room and everybody presents for about 15 minutes and kind of spills their guts. And it's nice because it's not collaborative. It's not competitive. At least I don't think it is. But everybody kind of spills the beans on what they're doing in their business. And there's a lot of celebrities, I think, in there. I'm kind of in awe. But for me, it's the getting around better people than myself. Some of the takeaways, I just cut and paste some of my notes. Like if you're a house flipper in this group, you're flipping 100 houses at least. So these are the pros. You don't get in this group unless you're invited in. But the first 2 lines there, it's kind of funny. Everybody makes the comment, let the HGTV amateur house flippers do the high risk flips, right? We're the pros. We're going to be taking down easier projects with less risk. And then, if you got a crappy property to sell, the best place to take it is the local RIA to sell your junk properties, because that's notoriously where all the newbies go. And that's why I say all the time, if you're a credit investor, the local RIA and the online free forums are some of the worst places to go. A lot of like the house flippers are kind of reverting back to turnkey products today because turnkey products are less in scope. So it's a way for them to de-risk themselves. Another thought was, scaling down instead of using, W-2 workers, get some VAs. You don't need to have an office these days. Save money, right? Some things are just not needed because you know, a lot of astute investors, they don't invest on a shiny office. You know, that's what the amateurs do, or like the regular people working day jobs. They go after financial planners with nice offices and big boardroom tables. And, you know, if you're producing 10, 12, 15% returns for your investors, they don't care about that stuff. One book that was talked about a lot was this Profit First book. It basically says like, well, make sure you pay yourself first and put some money aside, so in a recession you have money ready to go. Housingalerts.com, I kind of forget what that one is, but you guys might want to type that one up, and it's a good house data. But it was also brought up that 15% of the people have changed to being new landlords. So like, I think since the recession, there was maybe about, I don't know if this is true, but like 60% of the people were homeowners. Today, it's like minus 15%. So that means 15% of people in this country have become new landlords. So that means that there are a lot of unsophisticated landlords out there doing it the wrong way. And everybody thinks that they have it the right way, but you know, why is it that's only a few percent of people can, you know, amass 10, 20, 100,000 unit portfolios? Contribution, I hosted a mastermind at my house with all my Hawaii investors there. That was a lot of fun. You know, hopefully make a lot of connections with other people. Um, how I achieved significance? Well, I felt like I really socked it to the government this year for paying 4%. So I felt really proud of myself for that one. How I got uncertainty in my life? Well, if you guys watch the video of the fitness, I was working out for like 30 minutes, so you can watch me like sweating there. How I achieved certainty in my life this month? Well, I sold this turnkey rental. I had to pay 37,000 for a repaired bill to do it, but now I don't have to worry about all these like things that happen. I feel like syndications and private placements are the place to go if you have the net worth to play around with that stuff. Um, Ways I got love and connection. Well, I'm trying to get more better at planning stuff with me and my wife. If I don't plan it, it doesn't happen. So that's what I'm doing there. And some annoying things that happened to me. These annoying citations for these counties for my tall grass. This is like the weed notice here. I thought they were talking about like somebody was smoking weed at my vacant property, but apparently I just need to cut the grass. But you know, hopefully this thing sells this year, early next year. I don't have to deal with it. And you know, I'm sick and tired of like talking to people who still think 1031s are a good way to sort of move your capital around. I mean, it's a method and it's a tool in the right situation, but here's why I don't like 1031s. Like you need to go from a real estate to real estate and in a like kind of exchange. A syndication is not real estate. A syndication is a business, or I don't know what it is, but it's not real estate. So you can't exchange from your rental property into a syndication, even though it's apartment building or whatever. The problem with the 1031 exchange, and I'm always on the other side of it, as you know, as the buyer um, of the 1031 exchange, you're always desperate. Everybody knows you're dealing with 1031 money. I mean, we love it when the person across the negotiation table is a 1031 person, because we know they're desperate and they're typically going to pay 105 to 110% over market price. And if they're flexing their equity effectively every 5 years or 10 years, they're going to have to go through this whole deal again. I am really annoyed and sick and tired of all these 1031 custodians pushing this tool as, you know, all the time. I mean, yeah, I get it. That's how they make money. But like with bonus depreciation and, you know, these cost segregations and private placements, and this the ease of like going in and out of deals as they exit each other, I mean, I just think it's kind of making 1031 exchanges obsolete. Does anybody have any questions on that one? Just hopefully I can. So here are some things I bought this month. I like food. So I recently went, that's shave ice on the right, and then banh mi sandwich. The thing on the bottom is that's like a pork belly with the uni butter rice. So if you guys have uni before, they mix it in with the rice. That thing was like really good. So I didn't buy anything too crazy this month, just a bunch of food. But um, secret is I got something big I bought next month. I'll show. Um, so I'm reading this book, Deep Work. So I'm trying to read a book every month now. So this book is all about doing, well, as the title says, doing things that are deep instead of doing shallow work like checking Instagram, Facebook, social media, or like just doing 5-minute emails. Everybody is doing that and is becoming more common, but it does not create value in society, and therefore you will not be compensated for that. Some of the stories it talks about, some of these great thinkers, they'll go in the cabin in the woods, they'll get a hotel, they'll fly on an airplane to go somewhere special. Um, there's a blend between, you want things to be serendipitous encounters, and I think that was the whole idea between the whole open office concept. But at the end of the day, I think we still need most of our time to be a solo thinker, and to create value. The best way to get around that, the best of both worlds is hub and spoke technique. So you have your little cubby hole where you do your work, but then at your choosing, you can go to the hub of other people doing what you're doing to kind of create new ideas, but then you take it back to your spoke is the idea. If anybody has other good recommendations of books or any idea has read this, yeah, feel free to reach out. I'm always trying to look for ways to implement this into what I'm doing. Again, anything I said here is not to be taken as legal, or you guys need to get your own professional advice here. But that's sort of the end of the presentation. If you guys have any questions, we got a few minutes here. And anything on the news you guys have? So we had a couple of questions about syndication stuff, but that's more for the passive investor accelerator and mastermind. We talk about that stuff all the time in there. Any news related stuff people want to chat about? Okay, well, if that's it, I think what I'll do is I'll do one more breakout room. If you guys got to drop off, please drop off now so I don't leave somebody in a room by himself. But we'll go out to the breakout rooms and we'll see you guys next month.